What is up, everybody? Welcome back, and this is the first official lesson of the TTF Fundamental course, and we're going to be going over economic indicators. As you might have seen in the previous video, the three main factors, we're going to start from the left side, which is economic data, and that implies we'll be looking into the economic indicators. So these are some of the high impactful news events that you've seen, potentially if you've seen news before on Forex Factory, MyFX Book, and other news sites alike. But what we're going to be doing is I'm going to be showing you the ones that you should be looking out for, and then how do they impact news potentially. And what we're going to do in the next lesson is we're going to be going on Forex Factory and showing you how to read that. But as for now, I just want you to kind of get a general idea of what we're going to be looking for, when do they happen, and what actually are they. So starting from the top, we have the big boy non-farm payroll, NFP. Then right now interest rates are very, very important. The CPI and PPI, the consumer price index, and the producer price index, followed by the purchasing manager index, and we also have services PMI. Then we have retail sales, which can be medium to high news depending on what time of the year it is. Then another big boy, we have another big boy, we have gross domestic product, which can be very impactful depending on what stage you're at, and I'll go over that soon. There's multiple stages for GDP. And then we have the University of Michigan's consumer sentiment. It's a mouthful, but that basically gives us an idea of consumer sentiment, as it says. And then as far as the final two, we have trade balance and fiscal balance. I didn't add any slides on that, but basically a trade balance, what you need to understand is what is a trade surplus and what is a trade deficit. What a trade surplus is whenever an economy exports more value than imports. So basically it indicates that the economic and employment growth is good within the nation, and vice versa. For a trade deficit, that means they're importing in way more goods than they're exporting out, so they're at a net negative on that aspect, and so their economy is more dependent on the outside instead of themselves. And so that's basically the trade balance. Just kind of know what a surplus is, what a deficit is. Net positive is surplus. Net negative is a trade deficit. And so as far as a fiscal balance, it's also known as a government budget balance, and it's basically calculated between the government's revenues, which is taxes and the proceeds from all the assets they sell, and its expenditures. And basically what this means is if it's positive, then the government has a surplus, which means it spends less than it receives. But if the balance is negative, that means the government has a deficit and it spends more than it receives. Fiscal balance basically is a percentage of GDP. It's kind of correlated with that, and it's used as an instrument to measure a government's ability to meet its financing needs and ensure good management of public finances. So at the end of the day, if it's positive, that could be good. If it's negative, that could be bad. So before we get into the economic indicators specifically, what we're going to go over is the schedule for the news events. Starting at the top, we have Purchasing Managers Index. There are two basic things that come from this. We have the ISM Manufacturing PMI, and we have ISM Services PMI. Right now, today is November 2nd, so the ISM Manufacturing PMI, which is on the first working day of the month, actually happened yesterday on Tuesday, November the 1st. And then tomorrow, November the 3rd, is whenever the ISM Services PMI will be happening, because it's on the third working day of the month. Usually what precedes after is non-farm payroll, which is the first Friday of the month, unless it's the first day of the month. If November 1st would have been Friday, non-farm payroll would have actually been the next Friday. It wouldn't have been, it's never on the first of the month. After that, all of these kind of deviate from each other, but interest rates, the CPI and the PPI, happen during the second week of the month. Retail sales happen the second full week of the month. The University of Michigan consumer sentiment happens on the second and last Friday of the month. Then the gross domestic product will happen sometime the last full week of the month. Usually it's on a Tuesday, Wednesday, or Thursday. So now what we're going to do is we're going to move to the individual economic indicators and kind of give more insight to it. First, we're going to start off with the first thing of the month, the Purchasing Manager Index. And so like I've said before, you have the ISM Manufacturing PMI, which released on the first day of the month, and the ISM Services PMI, which releases on the third working day of the month. And the services PMI is the non-manufacturing sector, so it doesn't include like the automobile industry. But Basically, what this is that it surveys 300 purchasing managers regarding their business conditions, and it's useful leading indicator for future economic growth. So it gives it this is actually very, very important. So the purchasing manager index actually gives us an idea of what GDP could be. It's usually positively correlated with it. So if the ISM number is greater than 50, that means we're in industrial expansion, which is good. The market is expanding and we're growing. So we could see that the GDP could be positive that month. Vice versa, if the ISM number is under 50, that means we're in contraction and the economy is not doing as good, so the GDP might be lower. Next, we're going to look at non-farm payroll, and just put, usually it's everybody's favorite. It happens on the first Friday of the month, unless Friday is the first day of the month, like I previously stated. Basically, this is the indication of the number of people getting employed or unemployed in the prior month. It is a lagging indicator that depicts the previous month. It isn't necessarily priced in before the news drops, and it can take a little while after for it to be priced in. So if you're trying to trade non-farm payroll, which I don't really recommend if you are newer in trading, at least give it 15 to 30 minutes afterwards. Watch as the market literally just spikes up and down. And once it kind of sets itself, then start to look for some more entries. But actual greater than forecast is obviously good for the economy, and actual less than forecast is bad for the economy. But it is good for a long-term assessment on the economy, but never to be used as a main indication of what will happen. Very important with that. And like I previously stated before, it has very, very high volatility. So I do not recommend trading it as a new trader, but it's very entertaining to at least watch and see how price just spikes up and down like a little pinball. And the Fed, aka the central banks, like we talked about in the previous video, reacts to it. So it's still very important to view, even though it's a lagging indicator. And so a higher NFP indicates economic growth or potential inflation. Next, we're going to talk about interest rates. So consumer price index and producer price index. And the CPI is usually used by the government to calculate the level of inflation. Usually both are released around the second week of the month, like I've stated before. CPI is usually before PPI, but I put this month, but as I was writing this, it was in September. I believe in September the PPI was before the CPI. And there's other few exceptions, but normally the CPI is before the PPI. But central banks take note of core inflation numbers, and it affects consumers, it affects business owners, and it affects homeowners, because if the NFP is really high, that means there's a lot of spending in the economy, which can be great, but a lot of spending can cause high inflations. And when that happens, the central banks, aka the Fed, has to step in and they have to raise interest rates. So buying a car or a house, people generally use credit. And so interest rates will affect their decision to buy, because then now the interest rates have to be higher to help combat the high inflation. And so people are less likely to spend money. They'll wait to buy that house or that car, and it'll kind of calm the economy down. Moving on to the last statement, high interest rates aren't always bad, because investing in CDs and bonds, you'll actually get better returns. And other countries will invest in the currency because of higher returns, and it leads to currency strengthening. So that's a big thing in Forex. What happens is, although the interest rates go higher, the consumers in the country are less likely to spend money because they don't really want to pay the higher interest rates. But other countries will actually take money out from lower yielding rates and dump their money into an economy that has high interest rates, which will stimulate the strengthening of whatever currency that you're in. So it's kind of a fun fact. Retail sales. So this is the indication of consumer spending. It's usually released during the second week of the month, and the core retail sales are usually more focused on by the Fed. Actual greater than forecast, the currency increases. And so economic data analysis rules still apply. And I'm not going to go over that until the next video, but that is going to be I'm going to sound like a broken record when I say that, but economic data analysis rules are very important, which I'll go over in the next video. But crisis, gas prices, and weather can affect retail sales, because crises like pandemics happen, they're less likely to spend money. high gas prices. People aren't traveling as much. They're just going straight from home to work, vice versa. And they're not really wanting to spend money on gas anymore. So they're not really going out, going get drinks or going to games or whatever. And then obviously storms can knock out power, and it kind of knocks out our transportation to where we can't be as mobile and we can't go to shops and go to stores to spend money. So all that kind of ties into how retail sales can affect our economy. But high retail sales don't always indicate growth. And the one example I have is Christmas. Even if we are in a pandemic, people are still going to save up money. That way they can spend on others to buy presents for Christmas. So just because we have a positive, a very high retail sales number in Christmas, you have to understand that's the time that people spend, even if times are tight. Next is University of Michigan Consumer Sentiment. It's a very big word. So this measures the financial confidence of 500 consumers, which provides clues on future consumer spending behavior. This releases on the second and last Friday of the month of the full week. And so it releases on the second Friday of the full week and the last Friday of the full week. And also, the final release isn't as volatile because it's a revision of the first release. The first release will be very volatile, and then the second release will kind of have something to analyze from, and the forecast will actually be a lot closer that second time. So it's not as impactful, but it has a high to medium impact on Forex, more on the medium side. But basically, if the UOMCS number is greater than 50, that is economic growth. Consumer sentiment is positive and people have faith in the economy. Vice versa, if it's less than 50, that means it's in an economic decline. Consumers aren't as faithful in the economy, so they're more willing to hold onto their money and not spend. Gross domestic product. It is the indication of the market's value of the products and services produced by a country in a particular way. It's usually released on the final full week of the month, usually a Tuesday, Wednesday, or Thursday, like I've said before, and it measures the state of the economy and the growth rate. It is a lagging indicator. So whenever you receive the GDP in October, it is actually the data that was in September, and then vice versa, so on. But it's used as a guide for central bank to formulate economic policies, so like taxation and production rates and things of the like. And that's when the central bank might come in to usher in monetary policies if they need to. But to compare countries, you need to use GDP capita. So you can't just look at US's GDP and directly correlate it to maybe Euro or UK's GDP. You have to use the real GDP of that country, and you have to divide it by the population, and that gives you your GDP capita. But if there's nothing that you take away from GDP, you need to understand this. It's important to know the difference between advanced, prelim, and final phases of economic data releases for GDP. Advanced is the first release. It is the beginning of the new business quarter, so January, April, July, and recently it just happened in October. This is the most volatile release because it's the first report to predict the entire GDP quarter. So this is very, very volatile, like NFP volatile. And then following that is the prelim, which is the second release in the middle of the business quarter. So the first release is in January, so the second one would be in February, then in May, August, and November. And this is basically a revision of the advanced report, so it's less volatile. It's kind of like the University of Michigan Consumer Sentiment, where you have a first release that's very volatile, and the second release is a revision of that first release, so it's not as volatile. This is the same thing with the prelim. It is just a revision of the advanced report. Can still be pretty volatile if the numbers are way off, but usually it's a little more calm. And then finally is the final release, which is the third release at the end of the business quarter, so March, June, September, and December. And it's not very volatile because it's literally a revision of a revision. It's a revision of the prelim, which is a revision of the advanced. So usually the forecast is pretty spot on. There's still a possibility that it might not be spot on, and that could create some volatility, but for the most part, it's usually the forecast usually spot on to what the actual is. And so with that being said, that is the end of the economic indicator portion of this course. So in the next video, what I'm going to do is I'm actually going to boot up Forex Factory, and we're going to go over how to read the economic indicators and what to look out for. So catch you around. Welcome back, everybody, and welcome to the second official lesson. And in this lesson, what we're going to be doing is we're going to be viewing how to read the economic indicators. So right off the bat, as you could see, I'm on forexfactory.com. This is a website that I prefer to use. There's multiple websites that you can use for news, but personally, I like forexfactory.com. So once you head over to forexfactory.com, today is November the 2nd. So what I actually like doing is I like starting from the complete beginning of the month, and so I'm just going to go over this with you. So if you go back one, it'll go back the previous day, but if you click this, which is really cool, is you could set a begin and an end date. So what I'll do is I'll set the begin date on November the 1st, and I'll set the end date on November the 30th. That way I can just scroll straight through and it'll show me all the days instead of me having to click right every single time. I'll actually do another thing, which you'll see here in the top right is a filter option, which is pretty cool. If you select this, you can select the event types that you want to see, whether it's all of them, whether it's none of them, or you can select the expected impact. I just keep these all on, but for this sake, what I'm going to do is actually just select USD, and I'm just going to focus on USD in this course. But this correlates to everything. It just makes it a little less cluttered and easier to see from the perspective of teaching it. As we went over in the previous course, as you can see here on November the 1st is the first working day of the month, aka Tuesday. And so we had our ISM manufacturing PMI. So as you'll see here on the right, you'll have three numbers. The one on the right is the previous, aka the previous month. The forecast, basically the experts are forecasting the number to be, and then the actual is on release what the actual number is. And so a really cool feature is you can open the details. So make sure you are on the right row, and then you go all the way to the right and you click this folder, and it opens up a panel for you. So in this panel, it will actually give you all the information that I gave in the previous lesson, which is gives you definition, actual greater than forecast is good for the currency, release monthly on the first business day after the month ends. Next release, it'll tell you, and then all kind of notes, and it tells you like where is it derived from and all that jazz. So what's interesting about this is the fact that you shouldn't be just reading what happened just now. And so like what you can actually do is kind of forecast yourself of a prediction of what you think could happen. And so in this instant for me, which I'll be going over more in the final video, is I'd come to a conclusion whenever you click down here, there's like a little more option, which is very, very cool. And you can continue to click more until you come all the way down to 2011. So you literally can see all of 2011's data up until now. What I have found in the trade that I'm going to show y'all in the final video is that there hasn't been many times except May and April where the PMI was negative 2 months in a row recently. So that was kind of my assumption that I'm going to go over soon. But it's important to understand a trend, even in economic data. So as you can see here, majority of the times it's been around the same, or it's been positive for the most part. It's kind of been back and forth, but for the most part, it has been positive the past year from basically September till now, September last year to now. So it's very important to look at it from that aspect. Don't just look at it, what happened the previous month, what's the forecast, okay, what's the actual now, all right, it's going to do this. You have to look at it from a broad side of things, kind of how you look at the markets from a technical analysis perspective. You look at the daily, then you work your way all the way down to whether you trade the 15, the 5-minute, or so on. So that's pretty important. So as we have learned, since this was the first working day and we had the ISM manufacturing PMI, we should have the ISM services PMI on the third working day, aka Thursday. As you can see here, we can open the data yet again, And then we can see all the definitions. Actual obviously is greater than forecast, and it's good for the currency. And above 50 indicates expansion, below indicates contraction. And as you can see here, it hasn't happened yet, but you can almost assume that it's going to stay green. If I look back on a trend, you could see from January 7th all the way to August 5th, it literally held positive, where it just beat the forecast every single time. But there wasn't many, except May and June, there wasn't many times where it's stayed red. And so even here on 2019 for July and August, you had a 2 red streak. But other than that, it literally goes on huge green streaks when it beats the forecast. So we can almost assume, hey, I mean, until it's red, we can literally assume it's going to be green again. So like, this is the forecast, which is 55.5. I assume that it'll break that, and if it does, then that means interest rates are higher, and that means the strength of the currency will also increase. On November the 4th, we actually have NFP. Since it's not the first day of the month, it happens on this first week, so on November the 4th. And we have this same aspect, same thing where you get a definition, actuals greater than forecast, released monthly on the Friday, and then it tells you kind of what it is about it. But as you can see here, same instance, you've been green for a very long time. There is more streaks of red, but for the most part, it has been straight green. So that gives me an idea. It's like, okay, there's a good chance it could still beat the forecast, because it's been beating it ever since then, and you've seen no red from it. And so that's kind of how I look to view it. You can look at unemployment rate the same way. As you could see here, you click more and see the trend. Like, it held very high here in 2021, coming up through COVID. That's the aspect of what I look for. And so the second thing that I want to go over is the actual versus the forecast. Here's a very big thing that I see a lot of times, and people don't quite understand this, especially in NFP. And so what happens sometimes for NFP is the number might be positive, but it's not what the forecast expected. Just because the actual is positive in this case, so let's look at a time where it wasn't. So like, you could see here that the actual was negative, so this did a very big effect. And so the next thing that I want people to understand is how to read the actual versus the forecast. And so a lot of times this happens where people start to kind of get an idea of understanding how to read the economic indicators, but sometimes there's kind of a lapse in judgment of truly understanding what they're looking at, and that's okay. So that's what this course is for. There's sometimes in the market where, let's just use ISM Manufacturing PMI for example. Looking back at it, we had red numbers here. Just because the ISM number is greater than 50 doesn't mean it's gonna be perceived as expansion. Even though it's above 50, it is less than the forecast. The forecast, like April for example, it was almost 59 and it actually came in at 57. This probably negatively affected the currency. And so just because it's at 57 does not mean that the currency is going to do well, because it was expecting 59. And so there's certain times, especially looking at interest rates, because interest rates kind of confuse people sometimes. So if interest rates do great, the US currency can go opposite of indices like the NASDAQ and the US 30. And the reason is as follows. When interest rates go up, it will increase the currency strength, because other major economies of countries will want to invest in your country to make a profit. So the Forex USD currency will be strong. But looking at it from an indices perspective, it might not be the case, because higher interest rates means that people will be less likely to spend money. When people are less likely to spend money, the economy doesn't do as well. When the economy doesn't do as well, businesses go down. And then when businesses go down, the accompanied tech stocks like NASDAQ that holds a bunch of stocks, US 30, S&P, they go down. And so just because there's positive news doesn't always necessarily correlate with a positive effect of the economy, if that makes sense, especially during interest rates. So I want to make that very, very clear. Just to reiterate what we learned to kind of wrap everything up, when actual is better than forecast, that means it's usually going to be a positive effect on the currency. If it is less than the forecast, that means it's probably going to have a negative impact on the currency. If it equals the forecast, usually it kind of just pinballs back and forth and goes on its merry way. During news, especially red folders, I do not recommend trading them. If you are in trades in profit, I personally, what I do back everybody, and welcome to the second official. That means it's usually going to be a positive effect on the currency. If it is less than the forecast, that means it's probably going to have a negative impact on the currency. If it equals the forecast, usually it kind of just pinballs back and forth and goes on its merry way. During news, especially red folders, I do not recommend trading them. If you are in trades in profit, I personally, what I do is if I'm in enough profit, I'll either take partials and then set a break-even stop loss, but add a little more cushion to it in case of slippage. If I think that the economic indicator is going to be going in my trade's direction, because a lot of times it'll pinball back and forth to try and get everybody stops and then go on its merry way of wherever it wants to go. But if I have a good assumption of where I think I know where the economic indicator is going to go, then I will at least take partials and then put a break-even stop loss, but I'll actually give it some cushion, like I said, because of slippage, and see where that goes. I'll secure some profits that way. I have a free trade, and if it goes my way, it goes my way. If it doesn't, then I didn't lose anything. I still made a little bit of profit. But I do not recommend as a newer trader to trade this. What I personally recommend is if you know that news is going to happen, at least wait 15 to 30 minutes before, let all the shenanigans happen, and then let price kind of rebound, regroup, and then start looking for your trade opportunities. I hope you learned a lot in this lesson. Like I said before, forexfactory.com. You can change the begin and end dates. That way you can scroll on forever through eternity. Make sure you understand actual versus forecast. Click the folders if you forgot what the economic indicator actually does, or there's even some other red folders that happen, and it'll give you a rundown. Then you can click this more tab all the way at the bottom. I've already clicked it, but it'll show more data. Understand like how many times has it been red, how many times has it been green, has it been green too long, has it been red too long, what can you expect? And then up here, filter whatever currencies you trade. If you only trade /USD, like the major Forex currencies, then you can just use this. But it's important to have all the currencies on here. That way you have an idea if you trade the Aussie dollar, that Aussie news is happening. This wraps up the How to Read Economic Indicator course, and I hope you learned a lot. Peace. What's up, everybody? Welcome back, and this is the third official lesson. And in this lesson, we'll be going over sentiment and currency strength. In the previous lessons, we went over economic data and how to read them, and now we're going to go over the other two main factors that drive the market. And we're going to start off with sentiment first. So market sentiment is very overlooked, I like to say, and it's pretty strong depending on certain situations, because you can have a very strong economy and something like COVID-19, a huge pandemic happens, and it just shapes people's minds and not wanting to spend money because inflation's going up and other things of that nature. Even hurricanes and tornadoes can just wipe out environments, and it'll make people more frugal because they need to save up, because maybe they have to rebuild their roof or things of that nature. Even stock market crashes, they're less willing to spend money because their retirement's not as good, so they're trying to find other ways to save money for that. So consumer sentiment is very, very important. It can also be called sentiment analysis, and this is basically how traders feel about the future of the market. It's not very logical to go off by itself, but unless it's not normal times, and normal times can kind of be now, for example, where interest rates are basically becoming an all-time high since like 2002. Those can be factors that can come into play. And speaking of that, more specific things that can affect it, which is happening, like I just said right now, which central bank random actions. They keep raising interest rates because inflation is not going down, so they're just constantly raising interest rates, and they've made it clear that they don't care how the economy is affected by it. They want inflation to go down, and so they're worried about is raising the interest rates until that happens, and that affects us, the consumers. Elections are also a factor that affects sentiment. Oil prices surging, terrorism war, the war in Ukraine is huge. So speaking about that, kind of staying on topic of the war in Ukraine, one way of looking at things in a perspective of a chart is actually the CBOE Market Volatility Index, and is called the Volatility S&P 500 Index, and it measures the fear in the market. I'll get to that very soon, but then lastly, we have bond yields is a really good leading indicator. But going back to the CBOE Market Volatility Index, what I'll do now is actually put it on the chart for you. So if you go to TradingView and you left click, make sure you're selecting the chart, and you simply type in volatility. And you start to type in volatility. What you'll see here is the VIX, and so VIX, the Volatility S&P 500. Whenever you click that, you will see this chart. It can be kind of hard to read. If you need lines to make it easier, you can use lines. But basically with the VIX is that the higher it is, the more fear people have in the markets. If it's less than 20, people are complacent. They're chilling. But majority of the times it stays above 20. And so what you will see here is that the VIX will actually spike during crazy times, like during panic events. And I'm gonna switch to candles because it's kind of a little bit easier to view. And as I scroll out, you could see March 2020, whenever COVID hit, the VIX skyrocketed, as you could see here, and it's been slowly diminishing ever since. It had little moments of spurts. It'll literally just jump up and gap up, probably because like new strands would come out, and recently like it spiked up here and here, probably because of news of potential like World War IIIs, because Russia and Ukraine is happening. And so even if you don't watch the news, you could just tell if the volatility index is going down, well, there hasn't really been any crazy news that allowed people to start panicking. So this is kind of a good idea of knowing the sentiment of the market just alone. So this is called the VIX, the Volatility S&P 500 Index. Moving on from this sentiment, bond yield is a really good leading indicator. So we're going to go into bond yields. What they are is the leading indicator in understanding the economy fully, because as you know, the stock market will fall before the economy falls because it leads the economy, but something has to lead the stock market, and that's actually bond yields. It comes in basically four shapes. What they are is normal, which means the long-term rates are greater than the short-term rates. Steep, which is higher than the normal curve. This usually means strong economic growth, and it's usually met with high interest rates and inflation, which we could kind of be seeing now. Then we have a flat curve, which means that the long-term rates are basically equal to the short-term rates, and that leads to uncertainty, and there's a red flag for long-term investing. Investors don't really know what it wants to do, and so they might be thinking that we could be going into a recession. And inverse yield curve means that the short-term rates are greater than the long-term rates, and if the recession isn't happening exactly at this moment, it is literally about to happen. How to analyze the bond yield? The 2-year and the 10-year bond yields are basically the most important, because these are the two main periods investors look at when they're deciding how much confidence they have for the country in the short or long term. Should they be investing in the long term? Do they think the inflation is low, or do they think the inflation will be high in the future and they'll rather invest in the short term? What we're going to do is actually analyze this on TradingView in a second, and just so you can note it, when the 2-year is greater than the 10-year, that means there's an inverse bond yield curve. If the 2-year is around the same as the 10-year, that means it's a flat bond yield curve. And then whenever the 2 year is less than the 10-year, that usually means a normal or a steep bond curve. Depending on the separation, it could be normal or steep. What I actually gave here is a TradingView layout of the bond yields together. And so I'm going to put this on the screen now just to show you how you do this. Whenever you get the slides, you'll be able to just simply left click and add this into your charts. And so this is what you'll be able to add into your charts. So going back to TradingView, what I'll do now is I will type in US 10-year Y, and this is the United States 10-year government bond yield, and I will put this on the chart. What I will do is I'll actually switch this into a line chart, and so the 10-year is in blue. From here, what I'll do is I'll come up to where it says the US 10Y, and I'm not too sure if this is a TradingView subscription plan, if there's a limitation. I have premium, so I have the highest one, so I don't know if there's a difference between Pro Plus in this instant, but depending on however high, if there is a difference, you'll be able to see a little plus, and you can actually add a symbol on top of this. And what I'm going to do is I'm going to type in the US 02Y, and I'm going to put the 2-year inside of the 10-year. And I'm going to use same scale. You could change the color too. If you don't like orange, let's just make it white. What this allows us to do is to compare the 2-year bond yield curve, which is in white, which is usually the short-term investing option, and then we can compare that to the 10-year blue line, which is the long-term investment option. And usually I'll look at this on the week, maybe on the day, probably not the daily, either the weekly or the monthly, depending on what you do, but I normally stay on the weekly whenever I look at this. Whenever the white and the blue lines are together, that makes a flat curve because the 2-year and the 10-year bonds are basically the exact same. Whenever the blue is above the white, that means long-term rates are greater than short-term rates, so that is a normal to steep curve. And then as you could see here, the white actually crosses basically ever since July of this year. The 2-year has been higher than the 10-year, so it is an inverse bond yield curve. So there is a crisis to potentially come. It's basically what this is saying, because it's not good whenever the short-term yield percentages to invest in a country is greater than the long-term. So that's something to look out for. So usually what this means is that if we're not in a recession is coming, and that's not always the worst things. People are scared of recessions, but honestly that is probably the perfect time to build wealth, because usually all the stock market, all the big companies are basically at a premium. They're on sale, and so you can buy really low and everything will ultimately work itself out and go back up. So this is a good way to understand how to read the bond yield curves. And like I've said, I've saved this, so whenever you're looking back at this, you could simply go to the Google Slides that will be given to you and left click this and add it to your charts. And so next, what I want to do is go over currency strength with commodity correlations. And the first thing that I'm going to talk about is the USD currency. A lot of people know that commodity prices are priced in with the USD. They are negatively correlated. What that means, the CRB commodity index, when it goes up, the dollar index goes down, because when there's fear in the markets, people don't trust that currencies will survive, and so they focus more on buying metals and like physical resources that holds their value. And so whenever currency goes down, people are more willing to invest in gold and silver. I'll go over another example on TradingView as well. What we're going to do here is we're going to type in CRB and put a space, and this very long symbol TRJEFFCRB is the CRB commodity index, and we can overlay this with the dollar index, aka the DXY. What I'm actually going to do is I'm going to do a new price scale for this specific one. I will also change the CRB index to a line. The dollar index is in orange and the commodity index is in blue, and they are majority of the time negatively correlated. So like I've said before, whenever the dollar goes up, as you can see here, the commodity index goes down. And so recently the dollar index had a spike up here in September while the commodities went down, and then they had a tank down, and then commodities went back up. And so Like I've said, it's not 100% negatively correlated. Nothing truly is. As you can see here, both prices going up currently at this moment, but majority of the times they will be going in opposite directions of each other. So keep that in mind. Next, we're going to look at oil. There's two main currencies that are affected by oil. It's CAD and it's JPY. Majority of Canada's GDP is based on exporting oil, mainly to the US. The CAD currency generally has a high positive correlation with oil. So whenever oil prices goes up, that strengthens the CAD currency. Whenever prices of oil go down, that decreases CAD currency strength. Japan is actually one of the highest importers of oil. So they buy a lot of oil from other countries. That means they have a high negative correlation with oil. Whenever oil prices go down, JPY currency strengthens, because whenever the prices are lower, that means they get to buy it at a lower cost and they save a little bit of money compared to whenever oil prices are higher. Oil can actually be used as a leading indicator for CAD JPY specifically. It will never be 100% positively correlated, but CAD JPY will usually follow wherever oil goes. Gold and silver. The Aussie dollar is very, very, very correlated with gold and silver. It is major exports in most metals, including these two. And so whenever the CRB commodity index goes up, usually Aussie is following that, and it's not 100% correlated, like I've said before, but it likes to follow it. It could be a leading indicator as well. So now what I'm going to go into is more on the Forex side of things. You can use this for indices, but it's more Forex related, I would say. And it is something that I found recently on YouTube and modified it a little bit better. But I like to call it Forex ETFs or Forex indices. I set up a watch list so you can compare currencies to each other. So each Forex index or ETF is ranked with each specific major currency pair. As you can see here at the bottom, you have all 8 of the major Forex currencies: AUD, CAD, Euro, CHF, JPY, GBP, NZD, and USD. You might be asking, Jay, well, isn't the USD ETF the same thing as the dollar index? And the answer is actually no, because the dollar index includes the Swedish krona, but it doesn't include the Aussie dollar or the New Zealand dollar. Plus, the dollar index isn't proportional in the fact that it's weighted differently. Euro is actually 40% of the dollar index, but with these ETFs, it's actually proportionally weighted with all 7 of the other pairs. So whenever you're looking at the USD ETF, it is equally comparing itself to the Aussie dollar, the CAD, Euro, the franc, GBP, and so on and so forth. And so whenever you're watching this, what you'll be able to do is click in the description and find the slides, and you'll actually be able to click and add this watch list for you to use on your own TradingView, depending on what plan you have. I didn't know this until recently, but I'm pretty sure you have to have at least Pro Plus in order to view these ETFs on anything other than the daily time frame. I'm almost positive. You can quote me on that. At least try this before if you have the Pro plan, but if not, it's probably a TradingView subscription problem. So I'm sorry, but it's very helpful. And what this is, it's a simple way to gauge currency strength and form a directional bias in the markets. TLDR is basically you treat them like normal pairs. You do your technical analysis. I do it from the daily to the 1 hour. And it's used as tools to trade economic divergence. And so what I mean by economic divergence is that if I'm looking at the USD ETF and I'm looking to trade USD pairs, like the major Forex pairs, if USD ETF is going up, then I'll look at the other 7 ETFs and I want to see them going down. Whenever they're going opposite of each other, that is an economic divergence, and that means I have a potential trade opportunity. For example, if the USD index is trending up while the GBP index is trending down, then that means I will go to the GU Forex pair and I'm going to look for sell opportunities within my strats rules. Because if the GBP ETF is trending down, that means the GBP is weakening, and the US is going up, that means it's strengthening. So therefore, it is a good opportunity to look for sells. So whenever you go into these slides, you will highlight over this TradingView watch list, and whenever you click this, you will get to this screen right here where you'll see here at the bottom the 11 things. I actually added gold and oil and the commodity index in here for y'all. The main things are these 8 indexes. This is obviously my watch list, so I don't have this option, but somewhere here in the top right it'll say save or add to watch list, and you'll click that, and then it'll ask you to change the name. After you change the name, it will then be saved to your watch list. And so here you will see you could change your watch list as a little drop down. You should be able to see something right here where it says FX currency indexes, and so that is how you set it up. I'm pretty sure you can only have one watch list if you have free TradingView. I think you have to upgrade that. Again, I'm not too sure, it's been a while. If you're not able to save the watch list, it's probably the case, but I'm pretty sure you can have multiple watch lists on free TradingView. What I'm going to do is we're going to bring up the Forex commodities. We're going to get rid of this, and then we're going to go back to candles. What we're going to do now is bring up the Forex ETFs or Forex index watch list that I have. It'll look something like this. What I do from here, I will start at the daily time frame. Let's just go to USD. But basically, I start from the daily time frame and I do my technical analysis. I don't really like to write daily and 4 hour. I just color code everything. So for me, the blue boxes are the daily zones, the red boxes are the 4 hour levels, and the orange boxes are the 1 hour levels. So you just literally mark up levels to where you think is strong in support and resistance. You do that on the daily, mark up a few levels, and then you go to the 4 hour, find your levels. And so what I saw in the 4 hour, to go back a little bit, but I saw this area. That was the area I marked on the 4 hour. It was respecting this area here, so I thought that was interesting. And then so from there, I'll go to the 1 hour and I'll mark levels on the 1 hour. And from here, I'll actually view my chart. I'll keep it on the 1 hour time frame. And so I'll literally do this for all 8 of the indexes. And so basically, I will just do this for all of the other 7 indexes. I'll start on the daily. I'll mark my blue zones. Then I'll go to the 4 hour. I'll try and find some areas in the 4 hour in between that. And then I'll go on the 1 hour. I'll mark a few 1 hour levels. And then from there, I keep everything on the 1 hour because I like to trade on the 5 minute. I like to keep the Forex ETFs at least 1 to 2 time frames ahead of what I am trading. So since I'm trading the 5 minute, I'm going to stay on the 1 hour. If you're trading the 15 minute, maybe look to the 1 or the 4 hour, and then vice versa. If you're trading the 1 minute, then maybe look to like the 15 minute time frame or maybe the 30 minute time frame. It's just important to get more of a higher time frame aspect of it. And so I honestly treat this as a normal pair. And so in this case, I have a 1 hour level because it's orange. From this instant, what I like to see here is it comes back to the zone and rejects off. If it's rejecting off, I'm assuming that the US currency is going to be strengthening because it's going to be bouncing off this support and it could potentially be coming up here. So if I look at the New Zealand dollar, kind of same scenario here. I mean, there was news today, so that's why this huge candle happened. But as you can see here, this was a daily zone. And so if I was able to be in the markets around this time, maybe I could look to take a trade if I found something going down, since I'm thinking that it's going to break through this daily level to go up. And then what I would do is I would basically set an alert here, and then once it hits, then it might be a good time to take out, because then the New Zealand dollar currency could be weakening since it's potentially going to reject off this level, which it ends up doing. And then it ends up coming back here, and so whenever it's exiting this, I could assume that, hey, maybe it might come back and reject the daily. So I'm thinking that the New Zealand dollar can get weaker, and so I'll have that bias when I'm looking at the other 7 indexes. But this is basically my analysis that I've been doing recently. And so in the next lesson, what I'm going to do is I'm actually going to go over a trade that I took yesterday using this exact logic, and I'm going into detail of how I went about it. This is my first step in understanding how I want to go about trading. This is the side where I get my bias, my trend direction. I get what pair I want to trade, what pair is looking good to trade, what direction is the pair looking to go in, and from there I'll go into the charts and use the strategy that I'm currently using, which is obviously that outback, and from there I will look to wait for a valid entry to pop up in my favor, then take that trade. That covers sentiment and currency strength, and I will see y'all in the final episode where I break down kind of putting this all together and entering trades and exiting trades off of that regard. So I'll catch y'all soon. Peace. Okay guys, welcome back to the final lesson. And in this lesson, I'll be going over a trade that I took, basically using all of what we've just learned in the fundamentals course, just kind of all that wrapped in together. And so I'm going to show you kind of how I gave my fundamental analysis approach on taking a trade yesterday on AU. And specifically, this was for Strategy Wars, since this is obviously in November. And so what I did was I woke up at about 6:30, 6:45 a.m. my time. 7 a.m. my time is whenever New York opens, whenever Mixed opens, when I look to trade. I jump straight into the Forex ETFs that we recently went over in the previous lesson. And so what I'm looking for is this, and I'll kind of draw this out that way people can see what I mean by this in case people don't know what this is. Basically, for a sell opportunity for the Forex pair of AUD USD, there's a couple things that basically need to happen. Ultimately, if we're looking for a sell, that hopefully the price of the Aussie dollar or the strength of the Aussie dollar is going down while USD is going up. That means that there's a good sell opportunity. Or price could be going down while USD consolidates. Or the price of AUD could be consolidating while USD goes up. That can give you a sell opportunity. Or there's a very sketchier type of situation where Aussie dollar is tanking while USD is slightly going down. It's just the Aussie dollar is losing strength, they're losing value more than the USD at that current time. So these are the opportunities that we can look for sells in this case. What I'm looking for in the USD ETF or index, whatever you want to call it, is what is price doing? Like, what is this ETF doing currently now? What is currency? Like, where's the strength kind of sitting at? And so as you can see here, I had drawn this 1 hour orange level, and looking left, you could see it was a pivot point here. It respected it here to go up, respected it here, went back up, almost came back, but ultimately it's respecting this line. I'm very confident in that prices come down from this 1 hour level that I drew, and it's going to come down here and it's going to bounce off it. But what I truly want to see first is not only does it bounce off it, but it closes as a bullish candle. That just gives me more confidence. R is looking to close as a bullish candle. So this line is drawn here of basically when I'm entering the markets, and I am, like I've said in the previous lesson, I watch the ETFs when I'm looking to trade on the 1 hour time frame. And so this 6 a.m. candle closes at 7 a.m. So it's always like an hour later for me. So realize that whenever this candle closes, TradingView shows whenever the candles are opening, not whenever they're closing. So just remember that this 8 a.m. candle is technically closes at 9, but I don't always wait until the close of the candle. I like to wait till majority of the candle is filled. And so in this instant, you could see obviously in hindsight that this candle at between 8 to 9 a.m. my time is looking to bounce off of this support and go up. And so at this moment in time, it's probably about 8:10 to 8:20 where it's starting to fill this bullish candle. So what I'm doing now is like, okay, since price is going up, what I want to look at in the other 7 ETFs is it going down or it consolidating basically. And preferably I'd want to see this first scenario where one of the ETFs is going down while USD is going up. And so specifically in AUD, as you can see here, it is in a daily level because it's blue for me. I color code my zones. And so in this case, this is the 8 a.m. candle here. And as USD is bouncing off of a support, and it's about probably right here at the time of 8:20 to close to 8:30, around that same time, I could see that AUD is now breaking out and bouncing down off of this resistance. And so that triggers in my head, it's like, okay, AUD is weakening, USD is strengthening. I can look for a potential sell opportunity. So not only did I do that, but we used our economic indicators. And so I knew that it was the first working day of the month. And so as we've learned previously in the lessons, we have our ISM manufacturing PMI. It can help predict the future of the month to see how it does. And so in this case, what I did, I clicked more and I clicked more and I scrolled down. There wasn't many times recently where the PMI was negative 2 months in a row. As you could see, it did it in April and May, and then we could see it did it in July and August of 2021, and it didn't have a rough spree until kind of like that, until basically the beginning of COVID, like that area. In my head, I'm like, okay, the economic situation should still be an expansion because the forecast was 50. So I was like, okay, we're still in an expansion because our inflation is very high right now. The government and the Fed is increasing interest rates, so that should strengthen everything. So there is no point. We should be above 50. So that was my logic. So if we're above 50, that means that the currency is going to be strengthened, and if USD currency is strengthened, then for a pair like AU, since USD is in the back of AU, if USD goes up, that means AU is going to ultimately go down. So I had the economic indicator bias that USD is going to be strengthened, which would be a sell opportunity for AU. And then I also have in my Forex ETFs that AUD is going down, USD is potentially bouncing up. So I had basically two outside confluences of, okay, this could be going down. And so at this current time on Tuesday, I got all of this by around 8:20 to 8:30. And as you could see here, 8:30, I'm using the 5-minute CMOB strategy. The pink line is a 55 SMA, and then this blue and orange line is an 89 SMA. I'm just kind of playing with the 89 SMA, kind of using it as like a little area for rejection, but pretend this blue and orange line isn't here. So basically for the CMOB is the fact that I need it to cross under the 55. I want my stochastic to have crossed down as well, which it has on this little red line. Usually you have to wait an hour because this is a 1 hour, but I'm okay with not waiting that hour because I have all my confluences lining up, and I should be good to go. And then the Outback RSI and Hole indicator, whenever it's orange, that implies a sell. So this at 8:30, we are screaming sell opportunity. I actually went a little tight on my stop loss. It's personal preference for you. You can come up here, you can come all the way up here, but just note that your reward cannot be as high if you go for higher stop losses, and that's okay. It depends on your personal preference. And my personal preference, I actually like tight stop losses. I don't mind getting stopped out a lot of times, but when I do enter the markets at the right opportunity, which all these confluences would line up, I can get really good rewards very quickly. I still want to use technical analysis or more of price action because I'm not really looking at any other time frames other than the 5-minute at this point on this AU Forex pair. But what I'm going to see is I'm looking where price pivots, and I like to look at areas where resistance becomes support. And so I could see this little instant right here because I see here price comes up, price rejects it, now it becomes support right here. So this area was where I was looking at. I enter the sell at 8:30 whenever all my confluence for my strategy are good to go, and I enter here, and a couple candles later I end up winning the trade. And so this 9 o'clock candle for me is actually when news hit. And so when news hit, the ISM manufacturing PMI was 50.2. So it did do better than the forecast. I was correct in my analysis on that regard. So therefore, the USD currency strengthened. Whenever it did, it just tanked all the way down. Could I have gotten more reward? Sure. But it is news, and I wanted to at least secure it because I had about a 2.3 reward, which is really nice. Wrapping everything up, what I did was I start off with the USD index. I personally like to trade major pairs on Forex, and so what I'll do here is I'll start on USD, and I'm going to see the direction where USD is going. Is it going up or is it going down? If it's going up, then I'll have my bias to look at the other 7 Forex ETFs, and I want to see them going down to see an economic divergence. And then from there, I'll look and see if there's any news. In this case, there was. If there is news, then form your bias on what you think could happen there. Ultimately, though, if you're a beginner, I recommend not trading the news. Just waiting 15 to 30 minutes after the news. Let it play out. Let it do this weird little thing, and then go about your day. Or just look at a different pair if you're trading Forex. But if there's no news, then go about your day with just looking at the Forex ETFs and then understanding a bias using price action, maybe even technical analysis on the Forex or indices pair or future, whatever you're trading as well. And so from there, I got my bias of economic divergence with the Forex ETFs. Then I went to news. I found the news and got my bias from there. And then ultimately, I came back to my strategy and I waited for a sell opportunity to print, which it did. And then I looked left and I found a level that had been respected, both support and resistance, which is very strong in my opinion. And so I simply targeted that. And from here, as you could see, it was a very quick one on the 5-minute. It took about 30 minutes, as you can see there. That wraps up everything, guys. I really hope y'all enjoyed this TTF fundamental course. This is just kind of a beginner aspect of things. I definitely do plan on adding more towards this in the future, maybe going into more detail on certain aspects of things. But as of now, let me know what y'all think about this in the Discord, and I hope to see y'all soon. Peace.